Hello everyone, welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of July the 25th, 2016. Now, to get started this week, we're going to begin where we always do with the US dollar index, a driving factor in the futures, commodities, foreign exchange market. Everything centers around the US dollar in one way or another. So when we look at the dollar index, clearly it's got a bullish tone to it right now. We've broken through our current trend line resistance here, coming in at about the 96.70 mark. Very nice move here. And case in point, what we want to point out here is that dating back to basically the 1st of July, where we've had this big rally up right here, and then we've had multiple retests of the VantagePoint 18-day predicted moving average, only for the market to extend higher after that retest. So these are the kind of moves we're looking for here, guys. We're looking for this to continue. Now, when we look at some of our key indicators here, our neural index, our predicted short, medium, and long-term differences, and our trend strength indicator, all pointing higher. Our predicted MACD is above the zero line, also pointing higher, and our predicted RSI 75.7, somewhat of a concern here, guys. Definitely somewhat of a concern for a corrective move, if nothing else. But clearly the dollar is in a broader uptrend, remains in a broader uptrend, has been for probably the last 2-3 years, and that still appears to be in the cards of further strength. Now, I know there's a lot of talk about potential rate hikes in September, October, and this will fuel the dollar rally. But make no mistake, we are in summer trade, and things are going to be slow. We're not going to. I don't think we're going to see any real breakout moves until September, but the dollar will continue to inch higher. Now, to some degree, what's supporting the dollar rally is the intermarket correlation between the global equity markets, the S&P 500, the DAX 30, and the Nikkei, which is a very, very important component in foreign exchange trading as it relates to basically the global equity markets. Right now, as it stands, as the global equity markets go higher, the dollar, for the most part, goes higher against most of its major counterparts. Not all of them, but most of them. So when we look at the S&P 500, if somebody said to me, would this be at 2170? I would say absolutely not, but it is. Now, remember, a lot of this rally is maybe somewhat of a house of cards here when we're in a zero interest rate environment. And as long as we remain in that zero rate interest rate environment, then that will fuel equity rallies. But they're only short-term rallies in my respectful opinion, and I would anticipate a bigger downward move come September, but on a potential rate hike. But if the Fed doesn't hike, the equities will continue to go higher. Now, we are grossly overbought on the S&P 500, but we're not as overbought on the DAX 30 or the Nikkei. Now, with the Nikkei and the DAX is basically 100% inverse correlation to the euro currency, meaning the DAX goes up, euro US goes down, or the euro currency in general goes down across the board. The Nikkei highly correlated to the Japanese yen, so as long as the Nikkei is going up, the dollar yen pair is going up. The yen is weak across the board. So this continues to hold for now, but again, these equities, at least the S&P 500, is getting a little overextended, so we want to be careful there. Now, one of the leading indicators that may be pointing towards a corrective move on the global equity markets right across the board is oil prices continue to fall. When I look at the fact that we've lost this trend line support, we can see that the actual forecast lower on VantagePoint came back here. And I'll point out right around July the 1st on that dollar strength, we can see that basically we've had some up and down moves, but our trend line resistance has continued to hold. You can see all along here, we've had multiple tests along this area, along the VantagePoint 18-day predicted moving average, all of which has been fantastic selling opportunities here, guys. Fantastic selling opportunities. So this continues to point towards lower oil prices. This is basically, as we get in towards the end of July, beginning of August, oil prices usually start to turn lower, not higher, as summer driving season winds down. So this again points towards further US dollar strength, but potentially some weakness in those equity markets is potentially coming with that correlation to oil. But the most recent intermarket correlation again is equities up, dollar up. Now, as we move into our individual currencies in a moment here, we do want to at least revisit gold to see what's happening here. Now, when we look at gold, In an environment where we're going to be looking at potentially raising interest rate, that doesn't bode well for gold. Now we can see that essentially we are challenging this key vantage point level right here, the 18-day predicted moving average at 1327. We've closed below it at 1322. This is telling me we are probably coming down into the 1300 next week, or potentially lower. If we break through this trend line support, the demand area, if there's no demand at this price, then we will move lower into the 1250, 1260 range. That is unlikely to be next week here, guys. But I think a bigger move is coming. We've got a warning sign here from the predicted MACD from VantagePoint. Our predicted RSI, we can see 45.7. We've lost that all-important 50 level. And of course, the predicted short, medium, and long-term differences all moving lower. Now, the neural index is a little confused here. It's still pointing higher. So that could be the needle in the haystack we're looking for here. Because if those global equity markets do sell off here, guys, that could put a bit of a bid into gold. Now, as we move in next week for our euro currency, a few things we want to make sure we're understanding here. The key resistance right now, the short to medium term resistance, 110.62. We've closed well below that at 109.76. Selling into 110.62 remains the better play. Again, VantagePoint forecasting this down, the euro currency down, basically back June the 25th, we've been forecasting this down. We've had a retest of the 18-day predicted moving average multiple times here, multiple times. This was actually a short trade on Trader Planet this week. You can see the market coming up to the VantagePoint 18-day predicted moving average and failing every single time. This is indisputable fact here, guys. So the euro still remains broadly weak, but we also remain in an overall broader sideways market here. In my respectful opinion, we need to break through this level here, this 109 and 108.56 area. If we break through there, we're going lower. Now, when we look at our main indicators, our predicted short, medium, and long-term difference, and our neural index all pointing lower, predicted MACD lower, predicted RSI 26.7. We are getting somewhat oversold, but again, based on the last one of the last AAA crossovers in the last 3 months on the forecast, if we follow this down here, you can see the predicted RSI stayed below that 40 line for several weeks. So we want to also keep that in mind in our trading and not get caught up in overbought and oversold conditions. We have to look at the intermarket correlations to make those determinations. And right now, clearly the euro US remains in a sideways market with a downside bias. That, of course, would bring us to an upside bias to the US Swiss franc, the inverse correlation to the euro US pair. The key levels that we want to understand right now, 98.30. This is where, with my own direct clients, we've been buying off this. Excuse me, I'll just bring that back up so everybody can see it. The 98.13 basically represents our main support level right now. That is intersecting with our swing low trend line here. We can see, I'm just going to draw that in so everybody can see. And the trend line's coming in just above the key vantage point level, basically about 98.20. So we have some pretty solid support down here, guys, but we also have some very powerful resistance in this area up here, all the way up to 99.50. So we need to clear, the first hurdle that we need to clear is we need to clear through this trend line. Then we need to break through this swing high at 99.50, and then US Swiss franc, and only then will US Swiss franc have some decent upside potential. Right now, we're in a very tight wedge formation, and we want to be careful of both bull traps and bear traps, to be very clear. But again, the indicators from VantagePoint are pointing higher. Now, as we come into the British pound US dollar, the 127 area appears to be a swing low. The problem we have, or this pair has, is that based on the correlation of 30 other markets with a VantagePoint 18-day predicted EMA, we can see that the market is unable to break through this key VantagePoint level, which is 132.91. We need to break free and clear of this area on the upside if we have any hope of any sustainable long trades here. So basically, for the entire last week, clearly we have a downside bias still on this until we break 132.91. But with the Brexit a little bit manipulated right now, the indicators are very mixed, but predominantly I would say 80% of the VantagePoint indicators are still saying that we're going lower, and that's what we have to take into consideration here and not try and fight the market on this one. one. But be very careful with the pound dollar because it's very erratic right now. A little bit of good news, it goes flying higher. A little bit of bad news, it goes flying lower. A lot of the news we're getting really doesn't mean much here, guys. So keep that in mind. But right now, 132.91 is our critical level. Now, when we look at the dollar yen coming in next week, this is a tricky one here, guys. If that Nikkei sells off, then the dollar yen will sell off with it. You are trading equities, whether you like it or not. So you need to keep a very close eye on the Nikkei and the S&P 500, but more importantly, the Nikkei next week. If it starts to sell off, the dollar yen will move lower. With my own direct clients, we have been selling into the 107 area because, again, those equity markets are very shaky. We have mixed indicators on the VantagePoint, equity trades. When we look at our predicted long-term difference here, which is this guy right here, very concerning to me. Our medium term has crossed over our long-term predicted difference right in this area here. I'm just going to let me clear this so everybody can see exactly where I'm pointing to. Is this crossover point right here. Now, this is not a moving average crossover. This is a strength-based indicator, and it's saying that the medium-term strength is weakening versus the long-term strength. So this trade could be getting ready to reverse back down to its primary trend, which has clearly been down in 2016. So we have to keep that in mind. Our predicted MACD, we've had a big rally up off of that Brexit vote, but we're kind of going sideways on the predicted RSI. And again, our neural index is down. This is a problem. So in order for this trade to really work here, if you're going long, 104.78, I anticipate we will test this area this coming week. If this area holds, we can consider longs at this level. But if it doesn't hold and it starts blowing through, then we are likely moving back down to this lower area here, down around the 98, 99 level. I would say there's a better than 50% probability right now that that is going to happen. So be very cautious with this pair next week. And remember, when you're trading the dollar yen, you are trading equities, the S&P 500, and more importantly, the Nikkei. Okay, guys, very, very important that I get that across to everybody. Now, as we come into our final three pairs, our commodity currencies, the long trade here on U.S. Canada this week was a good one, getting close to our entry point. But the point is, we're getting the direction of these trades correct. Now, VantagePoint's triple EMA cross, we had a retest here last week. I could see price rising off the VantagePoint 18-day predicted EMA, 129.99, and of course, price has been rising ever since. Now, the problem we have here, guys, to some degree, is this very difficult trend line and swing high. This swing high comes off of this bar here, and we connect our trend line to this bar, and that brings us two levels here, 131.50, 131.80-ish area, and this 132. If we can break free and clear of 132, then and only then will U.S. Canada make a substantial move to the upside. Now, if oil continues to sell off, there's a better than 50% chance we'll be at 133 by the end of next week. But if oil recovers, US CAD fails at this trend line area here that I'm outlining, and I'm just going to take this off so everybody can see it. This trend line area right here around 131.80, if that fails, then US CAD will probably come back down to the key vantage point level, which again is this 18-day predicted EMA, 129.99. That's our retest area before our next leg up. Now, but again, it is going to be commodities are going to play a big part in this, guys. And what I've shown everybody here so far, commodities are pretty much down across the board. Gold's down. Oil is down. RBOB gasoline contracts down. So all of these point to weakness in the Canadian dollar. So the intermarket correlation, guys, what I tell even my own direct clients and the many different webinars that I do is that an intermarket correlation will trump any other indicator on your screen. I don't care who made the indicator, how wonderful the indicator is. It's 99.9% accurate. That 0.1, an intermarket correlation will overtake it every single time. So if the key thing next week, watch your commodities. If commodities recover, US CAD is going lower. Commodities remain under pressure. US CAD breaks through 132. Okay, now our indicators from VantagePoint, what I also want to point out is they are not even remotely overbought here. Okay, our predicted MACD coming off the zero line, neural index up, strength indicator up, predicted short, medium, and long-term differences all above the zero line, and that all-important predicted RSI 69.5. We are not at all overbought here, guys. We're sitting at trend ready levels. Okay, so keep an eye out for that breakout. Just be, again, very cautious of a bull trap up around this trend line area right here. Now, as we come into the Aussie currency pair, we can see we've got a pretty strong trend line coming in here. I'm going to just draw it in so everybody can see. We're connecting our trend line to our swing highs, understanding order flow. This is what order flow is based around: swing highs, swing lows. Order flow is a fancy word for swing highs and swing lows here, guys. Okay, so when we look at this, we can see, you know, we're just under that 77 mark is our main supply area. Supply is filled, price goes lower. This area here, the VantagePoint triple EMA cross, has completed, and we have a trend line break also under 75.03. The VantagePoint, again, the 18-day predicted moving average, a major support level at this particular time. So we've lost this area, we're moving lower, but we're still very dangerously close to that trend line and dangerously close to 75.03. As long as we stay below 75.03, we will have further downside with a potential target back down here around 73. Better than 50% probability we are going down to that level, especially if those equities and commodities continue to turn lower. But that's what it's going to take to push this one down. Now, our predicted short, medium, and long-term differences, our neural index is in agreement, our predicted MACD has crossed the trigger but still above the zero line, but our predicted RSI, again, 34.2, again, pointing to a trending move. Now, case in point, I'm just going to clear this so everybody can see this. I'm simply using this as an example as the last time that this happened with a triple EMA cross and a break of the RSI below the 40 line led to a substantial rally from 77 all the way down until it finally paused out at about the 69 level. That's a big move, guys. However, are we not, guys, at the exact same thing, the same exact setup happening right now? Does that mean we're going back down to the 69 level? There's a better than 50% probability that we are. So keep that in mind. All we're doing, what I love about the VantagePoint software is that when it signals are repetitive. It picks up on these intermarket correlations, gold's lower, oil's lower, equities may be going lower. It immediately feeds into the program and tells me that this pair is probably going to repeat what it did several months ago. So we're going to look for that same thing to happen again, and if it does, then we should see a substantial move to the downside on Aussie US in the coming weeks ahead. The same thing could be said for New Zealand. However, my optimism on this one remains guarded. And the reason I say this one, guys, is this doesn't look like the Aussie US. If we look at this one down here, our predicted short, medium, and long-term differences are oversold. Our strength indicator is rising, our short-term predicted difference is rising, and our RSI is at 27. So that doesn't mean we're not going lower, but we've been down for 1, 2, 3, 4, 5, 6 straight down days, okay? And to some degree 7 if we include Friday, even though it was a very sideways trading day. We would look for this market to pause. So could this bar right here be that pause and that new swing low when the market will recover from? It's possible, but I'm not convinced at this particular time. But the software is warning me using the strength indicator and the predicted short-term difference. It's warning me that this downward move on New Zealand is losing momentum, where the Aussie is just actually getting started, right? So that's the difference between these two pairs. And we certainly want to keep that in mind in our trading. So just a quick reminder here, guys, we are in summer trade. Things are usually very choppy, very sideways, and for the most part, we're just range trading. So keep that in mind and make sure you're always locking in profit on your positions, because that's the best way in summer trade to deal with these kinds of markets.